Our next guest has a great read on the consumer, chairman of Sunoco, vice chair of Gillon Property Group, which owns and operates luxury retail centers across the country. Bit of a Black Friday tradition right here as well to have Ray Washburne join us. Ray, good morning to you, and happy overall Friday. Let's start off, try and go through everything, because you have, as I said, a pretty good feel on things. Let's start off on gasoline. We actually haven't talked about it. We're, right around 57 on crude right now. What are you seeing at Sunoco in terms of volumes, both for for regular gasoline and for diesel?
Good. Well, David, thanks for having me on, and happy Thanksgiving. Listen, Sunoco, we're having a great year. We'll do about 16 billion gallons this year in sales, which is the largest in the United States. We're up 7% this year, but overall, gasoline sales are flat for the economy as a whole. But the one bright spot is diesel's up about 3 to 4%, which shows us that commerce is growing within the United States, moving things from factories to stores and things. So diesel sales, which were, I think, the largest in the United States in diesel sales, is very, very encouraging. But overall, gasoline sales are pretty flat for the economy as a whole.
And so what does that mean in terms of people driving then? What are you seeing?
Well, since President Trump came into office, we're down about 25%. It's around $3 a gallon nationally, not including California, of course, because it's much, much higher. But it just shows that the consumer is driving. They're just not driving. It's a pretty flat driving. But the diesel is what we're very encouraged by, because that shows manufacturing is actually moving things around the country.
Yeah. Did you guys ever try and figure out whether EVs are going to start to have a real impact on your overall business?
Yeah, well, EV is an interesting thing. If you track it, they're growing about 1% a year is what it's eating into gasoline sales. But that's a compounding thing. So 1% is not that alarming. The efficiencies of cars today is about a half point ding into sales. So it's about 1.5 points a year when you take efficiency and EVs, but it's nothing to worry that we'll worry about anytime in the short term.
All right, let's move on to luxury retail. We bring you on often to talk about that, given you've got a pretty good view from any number of the malls and the like, obviously in Texas. What are we seeing there? Is it holding up in terms of that high-end consumer thesis we talk so often about, supporting so much of the economy?
Absolutely is. United States, our luxury centers, which we have, around the country, we're up double digits this year, over 12%. The video you're seeing now is the Highland Park Village in Dallas. It's up about 14% this year in luxury sales. So we're very encouraged on the high-end buyer. They're out shopping, and you got to, as you see from these photos, you got to create an experience for them to go to shop within. And so we're very encouraged by the sales, and also our Christmas tree lightings at our different centers around the country. On now is Country Club Plaza in Kansas City. We had their lighting a couple nights ago, and the centers are full. I mean, people are out shopping, and we see it not only in the high-end luxury, but also in the mid-range tenants we have as well. They're up single digits in the 5 or 6%, but the luxury is really where the great growth is right now.
They're out shopping, but are they out eating? Because I know you also have a portfolio of casual dining, and those public stocks, the restaurant stocks, have not been pretty.
Yeah, but they're outliers. Chili's, which is Brinker International, has done extremely well. And what we're seeing in the casual dining space and the higher end space is we had a lot of pressure on commodity prices coming into this year. This year it's been flat except for beef. And beef is really because we're getting a lot of competition now from India, China, other countries that are competing for protein, which they weren't before. As far as the other casual dining, once again, it's the experience of the consumer. You have to create an environment. Brinker, as an example, came with that $10.99 three-part special, as well as their hamburger, and people frankly just traded up from the more QSR dining into it. The other brands, if you're not investing back into your business, the real growth for us this year and all across my whole platform is really the to-go and delivery services. They are on fire, and they went from 2 or 3% of our sales 2 or 3 years ago to today. They're 15 to 20% of our sales and higher. These kids under 35, they don't seem to really care to pay the delivery fees, and that has been a real eye-opener for us this year.
Yeah, we were talking obviously about the high-end consumer looking at your mall, but you do have a better sense as middle-class consumer from what you were just talking about restaurants, Ray. So what is your sense there in terms of their price sensitivity at this point and just the overall health?
Yeah, well, look, credit cards are tapped out. I mean, they're maxed out, but people are still getting out and enjoying the economy. Right now, we've had no problem hiring labor at all across our things. So labor costs are very flat right now. And as far as the consumer getting out there, I mean, they're hitting the malls and they're shopping. And so we're encouraged. Again, on the high end, the mid-range is still up single digits, which we're encouraged about. I've seen sales of companies like Abercrombie & Fitch and others, and they seem pretty encouraged going in. Going into next year, we're just anticipating kind of flat sales, not only at Sunoco and our gas stations, but also in our shopping centers as well. So we're not looking into massive growth in 2026.
No, but you are, listen, you come on and typically you tell it, my sense is when it hasn't been particularly good, you've been pretty straightforward in sharing that. So I'm hearing a pretty positive story from you. I guess my question is, given what you just said, you expect that to continue into 2026 and through much of next year?
Yeah, look, we have regulatory and tax with what the Trump administration and Congress is right now is businesses knows taxes aren't going up. The D.C. regulatory is coming down. And so that is a very big positive for business right now. But we're going into the midterms, and that's going to be a big concern next November when we have the same conversation. But right now, we feel very encouraged by everything. Inflation is held down. Construction costs really. Though the inflationary part of us is all this AI building boom, which is an entirely different discussion to have, but it's what has been really absorbing and consuming all the construction materials is going into the AI stuff. But we're encouraged.